adjourn to have a cocktail or a beverage or two. So Jeffrey, we welcome you back and thank you again for joining us.
Thanks. Good to be here. Thank you.
Okay, so folks, let's review today's agenda. We'll basically explain what is a charitable gift annuity, or CGA for short. We'll talk about the benefits and why you're joining us today. You maybe wanted to find out what it's all about, and we'd be happy to share benefits. And there are several, and we'd be happy to, as I said, share those with you. Here at the VNA, we have certain policies and procedures that we have to follow for this, and we'll explain what that is. And then Jeffrey will come and we've developed a couple of case scenarios to share with you and to basically show you how this works and really then show you what these benefits would mean to you. At the end of that time, we'll then open the presentation for any questions and any discussion you might have. And then at the end of that, when we conclude, we'll follow up with any next steps or other things that maybe you might have an interest in learning about. So does that sound like a good agenda for us to do today? It's okay with that? Okay, great. So what is a charitable gift annuity? Well, it's a way that a donor or another donor, two donors in total, can make a gift to charity, but at the same time receive an annual income that you can keep for life. It's a very simple contract that is developed between the VNA and our donor. The donor agrees to make a charitable gift in exchange for the charity's guarantee to pay life income to either one or two beneficiaries. We should just stop for a second and let me just share with you that not every charity, in fact, not many charities at all have the financial strength to offer a charitable gift annuity program. There's very few that do. And here at the VNA, now in our 45th year of service to our community, we're able to do that. And that's really because of the support of our many, many donors. Northern Trust is the VNA's financial institution, and they administer our program. And when a donor would pass, or donors pass, when that happens, then the remainder of that annuity then would go to charity, would go to the VNA. And again, we'll show you shortly how specifically that works. So what are the many benefits? Well, again, first and foremost, it's life income for either one or two people, let's say a husband and a wife, a person and a significant other, a person and a family member or friend, and the payout rate is based on what one's age is. Now, you can also receive upfront a partial tax charitable deduction. Again, one of the many benefits. In a moment, Jeffrey will be demonstrating a few examples on how one receives that tax deduction. And as we've mentioned, in establishing a CGA, you're not only supporting the VNA and the work that we do, but in addition, you earn income for the rest of your life, which supplements whatever your other income might be. But it also gives a donor an upfront tax deduction, which is the gift portion that they make. And we'll show you again how that works shortly. You also receive partial tax-free income. Now, what is that specific amount that'll be tax-free? We've done a few examples. We'll show you how that works, but it basically it gets determined on what one's age is. You also receive partial avoidance of any capital gains tax liability. You'll hear in just a few moments that you can fund a charitable gift annuity in either one or two ways: cash or through marketable securities, specifically stock. So basically with stock, many of you might recall that when you buy a stock, let's say you buy a stock years ago and it's $5 per share. Then years later, you decide to sell it and it's $10 per share. Well, that difference, 5 to 10, that $5 is the capital gain. And that must be taken into account. However, Jeffrey will show you shortly how that works. And again, it's basically a pretty easy process. It also will help reduce any probate costs or estate taxes that one has with one's estate after one passes away. There's also, and this is really the main reason that we would like everyone to consider this program, it's because you're supporting the VNA. And we know that many of you who are charitable and very philanthropic, you believe in our organization or the other charities that you support, and that's the real personal satisfaction that you gain in supporting a charity like ours. So it's very important. And at the end of the presentation, we'll provide and show you some information on the number of different programs that, with your support as a donor, how that helps our community with the many programs and services that we have. And finally, you'd be recognized as a distinguished member of the VNA's Nightingale Legacy Society. It's a great organization. You get immediately recognized. We have over 300 members to this special society. We gather quite often throughout the year for certain events where members have the opportunity to meet our leadership team, receive updates on what's going on with the VNA and our services, as well as gather for our annual luncheon where you can network and meet other Nightingales. With COVID, of course, we basically had to postpone for the past year and a half, almost 2 years, some of the programs and events that we were doing, but fingers crossed, we hope we see a light at the end of the tunnel where we're going to get through this COVID situation. And I'd like to share with you that we saved the date, February 8th. That is the date that we're planning to have our annual Nightingale luncheon, and that'll be held at the Johns Island Club. So stay tuned for more information on that. So we do have certain policies and procedures that we would have to follow, and I've just listed now there for you to see some of those. If anyone is thinking about initiating and starting a charitable gift annuity for the first time, the minimum gift must be at least $10,000. Should one look to want to do a subsequent one in the future, then the minimum would be then $5,000. And we have many donors who are part of our program who have done several CGAs throughout the different years they've been with us. So that's the criteria for establishing them. And as I mentioned before, they can either be done through cash or through stock. The minimum age must be at least 60 years of age. But we'll talk later on in the program about how one, especially for those under the age of 60, those younger folks, how they could look to start one, and it's called a deferred charitable gift annuity. And there are even some additional benefits for that. And we'll talk later in the program about how one could do that. The payment schedule is based on a calendar year, and the payments are made on a quarterly basis. So that means at the end of March, you would be receiving from Northern Trust your first annuity payment. And then subsequently 3 months later, at the end of June, next 3 months in September, and at the end of the year in December, again, receiving those payments. They can either be in the form of a check, or Northern Trust can direct this right into directly an online payment service. Now, we follow the American Council on Gift Annuities, or the ACGA, recommended payout rates. The ACGA is a qualified nonprofit organization that was established back in 1927. They have volunteers on their board of directors, and it's comprised of professionals who are active in the field of plan giving with some of America's most respected charities. They recommend the maximum charitable gift annuity rates that are used for charities and donors. And these rates have long been recognized, not only by charities and donors, but also by the IRS and state insurance agencies as being actuarially sound and in the best interests of all parties involved. And if anyone is looking for more information on the ACGA, they have a great website. We can share that with you at the end of the program so you could find out more information on that. But here is the ACGA's recommended payout rates. Now, everything is, again, as I said before, based on age. On the left side of your screen, you'll see that there is those rates for one life, meaning one donor, one individual. And starting at the age of 60, you see that that particular rate is 3.9. We've listed those in 5-year intervals, so you can see as you go from age 60 to 65, and you see how the rates are increasing. We couldn't list all the rates for one's given age. For example, if you turn 61 or 62, it's going to slightly then increase. But we thought we'd just show you in this particular slide how it works and how these rates increase. You'll notice on the right side of your screen what's called the to life, and that's if it's a donor and one spouse, a donor and a significant other, a donor and a family member or friend. And as you see the rates, they're just slightly less than what it is for the one life. Probably, the most important point as you see this and look at these particular rates, where can you get this type of return in today's economy and in today's economic conditions? Certainly not from banks, certainly not from CD rates or money markets. So it's one of those great benefits to have this and to earn additional income. Now, the rates are subject to change. There have only, I think just last year, there were 2 changes where the rates had decreased. So one has to keep in mind as they're perhaps thinking of making a decision or talking with your financial advisor about if this is the right thing that you would want to do. The rates could change. But the good thing is that if one would establish a charitable gift annuity now, when these rates are in effect, they are fixed. They will never change, even if the rates decrease. So why don't we get right into the heart of the matter, and I can introduce again Jeffrey Fry to join us, and we're going to be talking then and showing some of the different gift scenarios. And Jeffrey, if you don't mind, I'll continue with the presentation and advance your slides as we go through your part of the presentation. Is that okay?
That's good. Thank you. Pleasure to
Okay.
be here today. Thanks for having me, and hello to everyone out there. And I have to ask before I jump in, is Richard Johnson the Richard Johnson that I used to speak with at the VNA? And if so, hello.
He said yes.
Good to see you. So we've worked with the organization for a long time. I've been at PG Calc. I've been at PG Calc for almost 19 years. And before that, I was at State Street Bank and State Street Global Advisors. So I'm a recovering banker, as we like to say. And I've been on the plan giving side officially for the past 19 years. And we really value the client side of things at PG Calc. I suppose everybody says that, but we love our clients. And I think this is a great example. You're one of our favorite clients because you're such a wonderful organization. And so that goes out to the donors and the supporters of the organization, along with Dawn and Richard and Rebecca and others there. So thank you to all of you, and you're doing great things with your organization. I'm impressed with the list of services, and by extension, all of the donors and supporters are helping to do those great things. The story of gift annuities is, we're going to show a few specific examples, but what I want to stress at the beginning is that a gift annuity is a sort of strange vehicle in a sense, because it is a charitable, people ask, well, is it a charitable gift or is it an investment? And it's one of those questions that the answer to both is yes, because it is 2 things at the same time. It's what the IRS calls a split interest gift arrangement. And in this case, the VNA gets a certain portion of the gift annuity. It gets what's left at the end. And the we'll assume basically that the donor is the annuitant in our conversations today. So the donor gets a tax deduction up front for a portion of the total amount. And also, as Dawn went over, the donor gets income for life. And so we're going to take a look at 3 different examples and hope that you have some questions stored up so we can talk a little longer at the end. Let's look at the first example, Dawn, the One Life, a gift annuity funded with cash. So we have a 65-year-old, and we'll call him Bob Evans. That sounds familiar. And $10,000 cash contribution. So Bob Evans gives $10,000 to the VNA and Hospice Foundation. And what does he get back for his $10,000? He gets a charitable income tax deduction that is over $3,000. Now, why does he not get the full $10,000 as a charitable deduction because he is getting back a significant benefit from that $10,000 that goes into an annuity. We're going to talk briefly about these different points. The income tax bracket has some relevance. I always tell clients like Dawn, don't get too hung up on which income tax bracket to assume, but it does help us look at the real after-tax benefit for any of the donors. And so in Bob's case, we're saying that he's at the 32% federal income tax bracket. And I know that you don't have a state income tax bracket in Florida because you don't have a state income tax, but we generally talk only about the federal just because it's easier dealing with all of the states and different jurisdictions. So for simplicity, we'll just say the income tax bracket is the federal bracket of 32%. And in this theoretical gift annuity, we're going to see a 4.2% payout rate to Bob Evans. And that will be in the form of some ordinary income and a huge amount of tax-free income. Out of the $420 a year, that's what we call the annuity. It's $420 a year. The tax-free portion is going to be over $350, and that's for a significant number of years. We'll see the detail a little later on that. The tax-free percentage, that $351 out of $420, is about 84%. So only roughly 16% of the annuity for a determined number of years is going to be taxed as ordinary income. That's the second big benefit that the donors get from funding a gift annuity. They get the significant tax deduction up front, and then they get a tax preferential treatment to their income for what really comes down to being their estimated remaining life expectancy. And as I said a minute ago, the income tax deduction would be over $3,000. And here's where we do a little simple math. We would say that if Bob is at the 32% bracket and he gets a $3,000 deduction, he is saving approximately $1,000. His actual tax savings translate into about $1,000. We have $964 here. So that's a significant savings in his actual tax bill for the year. That's assuming that he could use the $3,000 deduction all in 1 year. We'll talk a little bit more about that later. But because of the tax treatment of the payments, we also talk about an equivalent rate of return, or in the real world, you might use the term a taxable equivalent rate of return. And that is looking at the comparison between a charitable gift annuity and a regular, a commercial annuity. And we do a comparison based on the tax bracket. And in this case, it would say that Bob Evans' 4.2% gift annuity is equivalent after tax. The benefit is equivalent to that of a fully taxable or a normal 6.5% annuity. So you may already be familiar with insurance products and insurance companies that sell annuities. And what we're saying is that based on these assumptions, Bob's benefit from the 4.2% gift annuity is roughly the same amount of benefit he would get from a fully taxable 6.5% annuity. So let's take a look at some of the details here. And just to disclose the full nature of how we do this, the VNA and Hospice Foundation have a license to use PG Calc's software. We've been in the business for over 30 years, 35 or 6 years now. And we have software, computer programs, if you will, that take all of these input criteria and spit out the results. It's hard to imagine what it was like doing these by hand before the advent of the personal computer in the 1980s. These things used to be done manually by hand, and they'd take over an hour to do a single gift annuity example. But here we have it at the click of a button. We have a page called Summary of Benefits, and it tells us some of the things we've already gone over. The gift annuity rate for Bob Evans would be 4.2%, and there's a cash contribution of $10,000. And then Don mentioned that the VNA, along with almost all charitable organizations who have gift annuities, all of you choose to follow the almost standard industry rates that are set by the American Council on Gift Annuities. So this is a rate structure that almost every charity follows. And I should just make a comment about what's behind these recommended payout rates. The premise is that out of any charitable contribution that creates a gift annuity, and in this case, Bob Evans' $10,000 contribution up front, the premise behind the rates that we follow is that the charity should end up with at least 50% of the original funding amount. So in this example, Bob Evans contributes $10,000. The 4.2% payout rate is based on a goal or an objective of getting back at least $5,000, that the VNA will have at least $5,000 left when this gift annuity ends, which would be at the end of Bob Evans' life. So it's not just an arbitrary rate that comes out of nowhere. It's actually based on some assumptions and calculations behind the scenes. But the summary page also tells us some of the most pertinent numbers that result. And the most obvious one is the charitable deduction. It's $3,012.90. It's dependent on a bunch of different things, but most importantly, it's dependent on that payout rate and what the life expectancy, the estimated life expectancy is for Bob Evans as an average in the population as a whole. So the deduction is slightly over $3,000, and the annuity, 4.2%, you can easily do that in your head. The annuity is $420. So every year, Bob Evans would get a payment of $420. Most typically, it's done in quarterly payments. And so it would be $105 4 times a year. And we've repeated some of this information. The majority of that would be in the form of tax-free income. So the total payment each year is $420, but the tax-free is over $351. That means the only amount that's taxable for the first roughly 20 years is $68.88. And that 19.9 years, I wouldn't want you to get too hung up on it, but just theoretically, statistically on average, that's what the IRS and the federal government would estimate as Bob's remaining lifetime. And just a word on that, we don't want to focus too much on expected remaining lifetimes because most people that we deal with gift annuities actually outlive their life expectancy. There's sort of a joke out there that the more gift annuities you do, the longer you live. So please give early and often, and you'll live to maybe 110 or 120. So, but 19.9 years, just based on the tables, the average, that is Bob Evans' life expectancy. You want to go to the next slide, Don? There. And so we have a really basic diagram in the computer program, and it just shows in this circle pattern the $10,000 cash contribution. It goes to the VNA. It's the VNA that issues the gift annuity. The donor doesn't actually issue the gift annuity. Don Rudolph and Rebecca and other people at the VNA, they actually write up the contract for this gift annuity. It's based on the software that my company provides. So the VNA actually writes up the gift annuity agreement once they receive the money from Bob Evans. And that results in the charitable deduction, and it results in the official promise by the VNA to pay the donor for the rest of his life $420 a year. So we just show the numbers down at the bottom as well. And again, pointing out that most of that payment for roughly 20 years, most of that payment is actually tax-free. So we'll just go to the next slide now. We have several pages that Don would use, sort of the standard process of running these calculations and seeing how the numbers come out. And this would be shared with you, the donor or the potential donor. And so in this case, it's a lot of the same numbers we've been talking about. The deduction amount is repeated here. The lower half of the page is really about prorating the first payment because it wouldn't be for a whole 3 months. Normally it's $105 every 3 months. If the gift were made, we wrote these up earlier in the year. So if the gift were made, I see at the top of the page that it's talking about February 23rd. So with the gift date of February 23, the first quarterly payment would be prorated. It would be $43.17. And thereafter, each quarter, it would be $105. As I said, it's $105 every 3 months for as long as Bob Evans lives. And really, he can live to be 90 or 100 or 110, and he's going to keep getting that $420 a year. The only detail here to take note of is that when he passes his theoretical life expectancy, then the income transitions in its tax nature and it becomes ordinary income. So beginning in the year 2042, that's when it fully becomes taxable ordinary income. And there's nothing wrong with taxable ordinary income. It's just not quite as sweet as it was in the years before when it was mostly tax-free. But he still gets $420 a year for as long as he lives, and it's taxed at whatever his income tax bracket is. So let's take a look at the next page here. And this is actually a very useful page. And some of our clients choose to show it to donors, and sometimes it's on a one-by-one basis. It's sort of the extra level of looking at a gift annuity. We mentioned earlier that the payout rate would be 4.2%. But a few minutes ago, I also mentioned that if you look at this on an after-tax basis, there's actually a bigger benefit than would appear to be the case. So if the charitable gift annuity pays 4.2% and a huge amount of it is tax-free for roughly 20 years, then on an after-tax basis, the benefit is actually more than 4.2%. And we crank out two different numbers here. At the bottom where it says rate of return, we actually talk about two different ways to measure what I guess they would call the tax efficiency. How much value is there if you look at this after tax? And the first number, rate of return 4.6, it's just a little more than the 4.2%. That is based on the benefit in just the first year. It's the benefit of getting the charitable deduction. It translates into what we would say is an effective yield of 4.6%. So probably still nothing to write home about. But the important number, and the one that I always emphasize, is the last number in the list, the equivalent rate of return. And I actually would like to have it relabeled as the taxable equivalent rate of return. You may have heard that phrase or used that expression with a broker that you work with or other financial types, the taxable equivalent rate of return is showing how the results of the gift annuity compare against a purely ordinary, fully taxable annuity or other kind of income producing vehicle. And it says that because of the unique tax nature, because most of the payments for the first 20 years, most of the payments are in the form of tax-free income, it simply says that this is equal to the benefit of a regular 6.5% annuity or a bond that you get 6.5% from. And good luck getting a bond that pays 6.5%. As Don mentioned earlier, these rates are very attractive even before you start putting in any analysis of them. Even 4.2% is a nice rate, but there are ways to look at it and understand that really in an after-tax perspective, it's really more than a 4.2% benefit each year. So that's just another sort of angle that people like to evaluate gift annuities on. And we're going to go to the next page now and look at our second case. And make a note if you have questions, and we'll have plenty of time at the end to cover them. This second case is for Angel Wings, a donor, and her age is 78. And this is a little different twist, and Don alluded to it earlier, where she's not prepared or she doesn't want to make a cash contribution, but she has $25,000 of stock, and we could make it really exciting and say it was something like Apple or Google or something like that that's skyrocketed in value over the years, and her cost basis is only $5,000. So it's worth 5 times what she paid for it. And that, that may seem a little exaggerated, but there are a lot of people out there who have stock that is worth 5 times what they paid for it. It is not really that extreme in the real world. We use these numbers to make a point that property, those stocks that are worth $25,000, the cost basis is only $5,000. There's an inherent problem with having that stock, which is that it's going to cost money and it's going to hurt a little to get rid of that stock. So you may or may not have been in this kind of situation where if you sell the stock, you want to use the money for living expenses, or you want to put it into something less risky. If you sell the stock, you have $20,000 of long-term gain. The value has built up, so that is now worth 5 times what you paid for. And at least at the federal level, you're going to have to pay tax on the $20,000 profit that you make on the stock. Doesn't matter how long you hold it. When you sell it, you have to recognize and report the long-term capital gain, and it's going to be taxed. Currently, the federal tax rate on long-term capital gains, with a couple exceptions, is 15%. The rate is 20% for the folks at the very top of the income tax bracket. And I will come right out and tell you that there is a lot of discussion going on in Washington that maybe the capital gains tax rate should go back up to a higher level, which it used to be at until a certain number of years ago. I think it was the Bush Tax Act of 2001 that brought the capital gains tax rate down dramatically. I think that was when they came down, but there's a lot of talk of increasing the capital gains tax rate, at least at the federal level. Right now, it's a 15% tax, and if you're over a certain income level, there's another smaller tax, the net investment income tax. So it basically turns into an 18.8% capital gains tax rate. And as long as you're in Florida, I don't think you have a state tax on that. So about 19% tax on that $20,000. That's going to be thousands of dollars in taxes that the donor would have to pay if she just chose to sell the stock. You can turn that into a charitable gift annuity as long as it's a marketable stock that they can turn around and sell. You can transfer the stock to the VNA and get a gift annuity based on that total value, the total $25,000. There is a little hitch though, which is that the government, the federal government, the IRS, they don't allow the donor to totally escape the capital gains in that stock. They require that a portion of the capital gains goes through the gift annuity. And we're going to see that in a minute on the next slide. But just for overall numbers, we'll do this in the way that we did the Bob Evans example. We can say that the payout rate would be 6.0%. And why is it so much more than what Bob Evans was getting? Well, it's because Angel is much older than Bob. She is 78, and I think he was 65. And that's the payout rate going up. The older you are, the higher the payout rate. So Angel would get a 6% annuity rate. Now, because she's using this appreciated stock, she isn't going to get as much of her annuity tax-free. Her total annuity each year is going to be $1,500. Remember, this is a larger principal than with Bob Evans. So her annual payment, her annuity, is going to be $1,500. But she's only going to get about $259 tax-free. It's not necessarily bad, but we're going to see how the other numbers work out. So roughly 17% of the income is tax-free. There is also a deduction, just like Bob Evans. She would get a charitable deduction of over $11,000 and tax savings of roughly, in her case, roughly 39% of the deduction translates into tax dollars saved. And the equivalent rate of return is 9.5%. So that's pretty exciting. We'll show that on the next couple of pages. So let's scroll to the next, and we'll look at the summary of benefits first. A lot of this I've already told you, the numbers being a 6% payout rate, the funding property, appreciated stock, highly appreciated, lots of capital gains in there, the deduction being over 11,000, the total annuity being 1,500. But what's different about this example is that the tax-free is just a small portion, and the largest portion of the 1,500 is going to be in the form of capital gains. This comes back to what we mentioned a little earlier. When the gift annuity is funded with stock that has long-term gains built in, that stock is transferred to the VNA, and the VNA sells the stock. And the IRS rules require that some of the capital gain is actually distributed back through the annuity payments. So Angel is going to get $1,500 a year, but she's going to get over 1,000 out of that 1,500 in the form of capital gains. Now, that isn't the worst thing that could happen, because remember, the alternative could be ordinary income. So there's really these three different levels of tax if the annuity is funded with stocks. There's a tax-free portion, there's a capital gain portion, and then there's an ordinary income portion. So the tax-free is the 259. That next category is really in between being tax-free versus being taxed at 39 or 40%. The capital gain portion would be taxed at roughly 18 or 19%. So it isn't the worst case, but we just want donors to understand that they can't make a gift of highly appreciated stock and have a gift annuity from it and walk away completely from the capital gains. There's a note on this page that Out of the, remember, the potential gain here is $20,000. And this is where the additional benefit is made in the gift annuity, because the IRS says, yes, we're going to recognize some of those capital gains, but we're going to give you a break on the rest of them. So the IRS is saying, we're going to tax approximately $10,900 of the capital gains, but the remainder of the capital gains are written off forever. They never come back. So Angel gets away, so to speak. She gets away with over $9,000 of capital gains. She escapes tax on over $9,000 she'll never be taxed on. And that is really a huge benefit. It's not a benefit that someone gets if they use cash for a gift annuity. It's only if they use appreciated securities. And in this case, because she's older, it says that her expected lifetime is 10.5 years. So in her case, she'll get these different categories of income over 10.5 years. And after that point, it all becomes ordinary income. But just like we said a minute ago, it's not a bad thing. It's just that it's suddenly no longer tax advantaged. It is now ordinary income, but it's still $1,500 a year. As long as she lives, she can live to be 90 or 100 or 120 and whatever. That is going to be her income for the rest of her life. So a very attractive benefit here. Let's look at the next page. This is just the simple diagram again. It has a little bit more information because we're building in the capital gains now. And in this case, I mentioned the number earlier, $9,110 in long-term capital gains that Angel Wings will never be taxed on, which is just, to me, even though I've been in this a long time, to me, that is just an amazing benefit, that she gets away with no tax on over $9,000 of capital gains. We can move on to the next page. Dawn, this is the page we call the taxation of gift annuity payments. And this is where we spell out in more detail how the taxation would play out over the years. And you've seen these numbers before, we've talked about them. This is just a specific page to show you a couple of things. One is how the first payment would be prorated. And in Angel's case, her quarterly payment's going to be $375, but the first payment is a portion of that. And then this schedule at the bottom that we call breakdown of annuity, that is the year by year taxation on the annuity. So the first year is a prorated year. And then there are 9 years where she gets that 1,036 in capital gain, and then a transition year. And in the year 2032 going forward, that's when it all becomes ordinary income. So it's a powerful example here of the benefit that the donor can get using appreciated securities. We'll go to the next page now. And if I go too fast, Dawn or Rebecca will yell at me and tell me to slow down. We're going to just talk about this for a minute, the return based on cost of plan. This is that sort of extra layer of benefit, of analysis, looking at this gift annuity. And this is more complicated than the previous one because this has different categories of income. It includes capital gain. And in this case, we say that for the first year, because she gets the deduction, her benefit is not really 6% of the principal, it's really 7.1. It's a complicated calculation, but it says basically that the deduction gets you a certain amount of tax savings, and then that turns into a benefit expressed as a percent. I actually don't really like talking about that number, but we've still got it there, so I have to mention it. The real number that I focus on and that I like to point out to you is that the taxable equivalent rate of return is 9.5%. So we're saying here that the benefit from Angel Wings' 6% charitable gift annuity The benefit from that is the same as the benefit from a normal, regular, fully taxable annuity issued at 9.5%. And that is incredible because Angel is 78, and that's young nowadays, right? I mean, that's young. It's looking younger all the time. So the fact that she can get a 6% charitable gift annuity that translates into a regular investment paying 9.5%, as Dawn has said, where the heck are you going to get that kind of rate? Nowadays, where are you going to get that kind of rate from something? So this is, as I mentioned at the beginning, the gift annuity is a unique vehicle because it's both a charitable contribution and it's also an investment of sorts. And some people look at it just as an investment and they say, hey, I can get 9.5% income yield from this gift annuity, even though it's officially a 6% rate. It's just a fantastic benefit and just makes a lot of sense. Let's move on in the interest of time. We wanted to show you an example that has two people in it. And as Dawn mentioned earlier, you can have a gift annuity written for one person or written for two people. It can't be more than two. They don't have to be related. There are a few cases where if they're not spouses, one person setting it up and another person getting some or all of the payment, there can be some other tax concerns. So Don will give us a call if he runs into those situations. But sort of plain vanilla, husband and wife funding a charitable gift annuity, they're 83 and 80. And we're going to talk about a cash funding again, just to make it simple. And their income tax bracket is lower than what we've seen before. So they're at the 24% federal income tax bracket. And notice the payout rate. The payout rate is 5.6%. And this goes back to what Dawn showed us earlier. If you have two people named, then just by definition, the payout rate is lower. Payout rate is lower because two people combined have a longer combined life expectancy than either person individually. So that just translates into a lower payout rate. It's still not bad. 5.6% isn't bad. And that would give them a $2,800 annuity. There's a huge tax-free percentage. It's 87%, and the deduction's over $21,000. Which gives them tax savings. If they can use the deduction this year, they have tax savings of over $5,000. The thing we should make sure to mention is that if the charitable deduction is so large that the donor cannot or the donors cannot use it all in 2021, the federal government does allow the deduction, the unused portion, to be carried forward to the next calendar year and up to 5 additional calendar years. So if the income isn't very high, relatively speaking, and the deduction is fairly high, it's not that they'll lose it completely. They'll just be restricted to how much of it they can use each year. We are in a special circumstance in 2021 because deductions from cash gifts are this year, the deductions from cash gifts can be taken up to 100% of adjusted gross income. We thought that was a one-time thing in 2020, but we then got the good news that it was going to be in effect for this year as well, part of the economic rescue package, combination of things that we've been seeing. And so there is a special rule for 2021. The tax deduction from a cash gift can be applied up to 100% of George and Judy's adjusted gross income. The equivalent rate of return is 8%, and that's something that I'll go through again in a few minutes. It's how you take that $2,800 annuity and you find out how much it's really worth when you compare it to something that's fully taxable. So we'll go to the next slide here, just quickly go through this here. Dawn and Rebecca haven't yelled at me yet, but I know we're getting toward the end of the hour. So we have the facts of the case again. We have the charitable deduction over 21,000, and we have the tax-free portion. This is really amazing when you look at it. A $2,800 annuity and $2,442 of it is tax-free for 11.8 years, almost 12 years. They get $2,400 and change tax-free for roughly 12 years. It's just a fantastic benefit for them. Let's scroll to the next screen. In the interest of time, we'll see our circular diagram here. We're not dealing with capital gains on this one. We're back to talking about just cash funding, and it just spells out the benefits again. $2,442 rounded up to the nearest dollar, $2,442 tax-free out of $2,800 total for the first 11.8 years. Where can you get something like that? That's just really wonderful. And then the taxation of gift annuity payments, you've seen this a couple times before. It just spells out what the regular quarterly payment would be and what the first partial payment would be. And then in the bottom, it shows you those years, the 2022 to 2031. It shows you that those years are showing the $2,400 of tax-free income. A very small portion is ordinary income until the year 2033. And again, they'll keep getting 2,800 as long as one of them is still alive. They'll keep getting the 2,800. It just won't be tax-free anymore. So let's go to our last page here, the return based on cost of plan. Again, I wish we could rename this page, because really what it's talking about is the taxable equivalent rate of return. And if you've ever had municipal bonds or any kind of tax-free bonds, this is the way the financial dealer types talk about it. They say, well, it's a 3% municipal bond, but the taxable equivalent is really 5%. They're saying that if you buy a municipal bond that pays 3%, the after tax, the true benefit of it is like a 5% regular bond. That's all this is doing. So in this case, we're saying that the nominal payout rate, the official payout rate, is 5.6%. And then there's this one little calculation. I don't like the rate of return, but that's just 1 year only. It's based on the deduction. But the important number is at the bottom, the taxable equivalent rate of return for these donors is 8%. This is saying that these donors would get 5.6%, but because it's mostly tax-free, it equals the benefit of an 8% taxable investment, which again, I don't mean to exaggerate here, but to me, that is such a tremendous benefit to say we're getting the equivalent of 8% from this gift annuity. And wait, there's more. It's a gift. And the VNA is going to get money from this at the end. After all of this, the VNA is going to get the remainder of this. The one thing that we don't get into here is how much the VNA will receive on these gifts at the end, because frankly, there's no way to know or predict how much will be left. The payout rates, they're very sensible. Payout rates are based on an assumption that what we call the remainder charity, the VNA, the remainder charity should get at least 50% of the original funding amount. So in this last example, this payout rate is based on trying to get the VNA at least $25,000 at the end, hoping that out of the 50,000 that it started with, hoping that at least 25,000 is left for the VNA to do the good work that it does. And the Dawn has a list of services that's just really amazing, all of the different services that the VNA and Hospice Foundation provide. So you would know, having a gift annuity, you would know that what's left of it, hopefully at least 50%, maybe more, is going to go to the good work the organization is doing. And I will also tell you that organizations that run good gift annuity programs and partner with good financial institutions like Northern Trust, that it is not unusual for the gift annuity remainder, or they technically call it the residuum, what's left of the donor's money in the end, if things are done well and good rules are applied and good investments are handled, it's not unusual for there to be 60, 70, 80, even 90% of the original donor contribution left at the end. That's on top of the donors getting 5 or 6 or 7 or 8% a year in the form of payments. It's all about managing it well and running the program well and being organized and on top of it, which I know the VNA is doing. So it's not clear what number will be left. It depends on all the unknowns in the future, but chances are it's going to be more than 50% of the original funding amount. So I think, Dawn, is that the last slide that I do? That's the last slide
yes,
I
Jeff.
do.
Thank you so much for sharing all that great information with those who are joining with us today. It's we have a moment, if folks will still permit, to take some questions. If you'd like to ask, please just this is the time then to unmute, if you would.
Kathy?
Oh, okay, should I just go? Jeffrey,
Yep.
Thank you. My question is, if somebody opens a charitable gift annuity at 65 and they put in X amount of dollars and they get a certain rate, that travels for the life of the annuity. When they turn 70, if they do another one, are they given that 70?
Yes. I know
Okay,
what you're asking. I know what you're asking. They get the rate for a 70-year-old.
On that particular one?
Not on that annuity. It doesn't change on the annuity. If they set up a gift annuity at 65, that is the rate for the rest of their life on that gift annuity.
But if you open a new one.
But if you open a new one, you get the now current rate.
Okay.
And those are subject to change. And I can't tell you for sure that the rates are going to be higher in the future, but gift annuity rates tend to follow interest rates and inflation rates, both of which are starting to tick upward. So, if I were betting on it, I would say rates are probably going to be higher in the coming years, but yes, you would get the rate for the 70-year-old if you did a second one 5 years later. That's a good question.
That was a good question, Kathy.
Yeah, thank you.
Hey, Jeff.
Yeah.
Hi,
Richard.
You mentioned that you were going to tell people about the deferred gift annuity. You might want to just make a few comments about that.
Yeah, we didn't really think that there was time to build it in completely to the program, but I can just tell you, I was actually doing a quick calculation before we started, and so for every year that the donors are willing to put off receiving payments, they get a higher payout rate. And Richard, it's an excellent point to bring up. Thank you. Because for the 260-year-olds that Dawn showed us at the beginning, the 260-year-olds, that because there's two of them and because, hey, 60 is young. It is young now. So for 260-year-olds, they get a 3.6% combined payout rate. But I ran a quick calculation to show, and Dawn, what's the minimum age you start making payments? I forget.
60 years.
It is 60.
Yeah.
So if you have two 60-year-olds that say, hey, we're not even retired yet, we want the tax deduction now, and we want to give you the money now, but we're going to wait and take payments in some future year. So I ran quick calculations. If the two 60-year-olds wait for 5 years to start taking payments, then they would get a rate when the payments begin of 4.3%. And because 60 is so young now and looking younger all the time, if they waited 10 years until they were each 70 years old, the rate would go to 5.5%. So two 60-year-olds, they decide they're nowhere near retiring. They say, we're just going to wait 10 years to take our payments. The rate would go from 3.6 to 5.5. And the older the initial age, the higher the payout rate would be over any period of years. It's always going to be higher if it's in future years or if it's for older persons. So this is one of those areas where it's good to be older, but but at any rate, you can start young and you can do the deferred gift annuities, and that rate will keep going up the longer you make it deferred.
Anne-Marie?
Richard, did that answer your question?
Yeah, we should mention that the VNA has a 55-year-old threshold as far as setting up a deferred gift annuity. They just can't get payments until they're 60.
Till they're 60, right. Was there another question I saw
Yeah,
a minute
Anne-Marie,
ago?
I think.
Go ahead.
Maybe unmute Anne-Marie. Yeah. We might have lost Anne-Marie on that. Just one of the things Jeffrey pointed out, and we've been talking about, where would one's gift go to? And we just thought to share a little bit of the slide of the wealth of services that the VNA offers our community that constantly and consistently needs to have funding. So if someone would, to say that they would want to direct their gift to our general mission, well, very often a portion of that gift would support many of the different programs that you see in front of you right now. However, there could be a donor that says, my family has experienced the great services that the VNA offers for hospice, and we really wanted to make a gift that would be for hospice. So they can elect to just have that gift set. We would then work with them to make sure that gift 100% goes to support hospice services. That's what we call a restricted gift. But some of these things that you see below, the charitable patient care, it's because of the donors like you and many others. The VNA will never turn a patient away who can't afford or doesn't have the ability to pay for health services. The mobile clinic here in our community travels around to help those vulnerable people who don't really have the healthcare services. Bereavement, someone loses a spouse. Well, we have counseling that can really help through that very difficult process to help support that person and to make them better. Telehealth, hey, now more than ever with the challenges that we've all been experiencing here with COVID, with folks not wanting to leave their homes, and we're able to then have telehealth services where that patient can commute with their doctor or their clinician and get the services that they need without maybe leaving home. As well as, we don't, in the interest of time, don't have the ability to go through here, but just a few others. Camp Chrysalis. Well, how about a child who loses a parent and how difficult that is at a young age? Well, we have services that helps those young children to cope with that loss. And maybe last one of my favorites, of course, is the power of music. Those who are suffering from and in pain for things like dementia or they just have Parkinson's. It's amazing. It's truly remarkable. We've all seen who work here at the VNA, the power of what the music can bring when our musical therapists come in. To have someone who is just lifeless and just there's nothing in one's eyes, and then all of a sudden a favorite song that they knew in their lifetime comes on, and the eyes wide open, and they start singing and communicating with their family and our therapists. It's just really a sight to behold. So lastly, folks, if you would like additional information on a charitable gift annuity that we have here at the VNA, I'd be happy to speak with you. Here's my telephone number, my email address. We have more information also on our website, at the VNA website at plangiving.vna.org. And finally, we mentioned earlier about services we're delivering right now, especially during this difficult time with COVID, to those who are homebound. Again, if you know of a friend, family member, your neighbor that needs the services, please get in touch with me or call that particular number, and we'd be happy to administer the vaccine as well as the flu shot to those folks who are homebound. Thank you so much for everyone joining us today. And we did run a little bit over. Jeffrey, thank you so much for your support as always, and all your colleagues at PG Calc. We wish you all the best. Take care and stay safe.